What an interesting week. Alphabet actually put out what I thought was really great results, especially with a return of digital ad spend. But what all people were focusing on was the weakness relative to their own expectations of the growth in the cloud business, and the stock dropped almost 10%. And so in this video, I want to dive into these results and see if Alphabet is in a position where we could potentially be starting a position. But before we get into that, don't forget the sponsors of the video, which is the like and subscribe button. Let's go. So right off the bat, you can see that Alphabet dropped 9% over the last 5 trading days. And when it's trading at a forward consensus price to earnings ratio of 21.5, I think you're in an environment where you're going to be seeing very limited downside, in my opinion. Obviously, if earnings can go down, you're going to see a little bit more downside. I just don't see that in the long-term cards. And, anytime we purchase these securities, we are looking at them long-term. And so I just don't see a material amount of downside at the current valuation. That doesn't necessarily mean that there's a material amount of upside. Kind of have to look at what the trajectory of the business is that we expect. And so I'm going to dive into that a little bit more. But I always like to look at market consensus. And so you got 43 analysts who have provided December 2024 EPS consensus estimates. And so, it's a very widely covered security. And so they're essentially saying that the company is going to make almost $7 a share in 2024 on an earnings per share basis, which reflects approximately an 18.4 times consensus EPS estimate. So, it's only really trading at 21.5 next quarter, which is, 1 quarter plus a trailing 9 months. Really, when you're thinking about the next 12 months, or call it next fiscal year, which is their fiscal, year ending December 2024, you're seeing that they're trading at approximately 18.4 times earnings. So much cheaper than what it actually says when you just log into Seeking Alpha or any other aggregator that's providing you with forward-looking estimates, especially this late in the year. So you guys got to pay attention to that. So what exactly happened with the earnings? Well, overall, I'm just summarizing this Wall Street Journal article for you. The investors were just too bullish on the cloud segment growth. And I think, we saw something similar with Alibaba a couple of years ago, where people are expecting, 35, 40% cloud segment revenue growth, and you just never saw that. And so they're telling you right here, the search giant delivers a mixed picture as the server business diverts attention from online ads growth. And so the way I think about it is that a rebound in the digital ad spend space is actually a huge story that a lot of people are ignoring. This is the bread and butter for Google and Alphabet. And so if the company is starting to reignite the fire in this segment, I think it's a big and a very important story. Now, looking forward, if we expect a consumer slowdown, this could turn, because the ad spend market, especially in the digital space, can be back and forth, right? And so, or can be cyclical. And so we got to pay attention to that. But the fact that it's not turning around, the fact that it's doing so very well in the current environment is very exciting. And I'll explain to you guys what I was forecasting for this year relative to what they've been able to accomplish. They have blown through my estimates. And so that's very, very positive. And we're in a cost-cutting environment, which is why I think as companies are approaching their fiscal year 2024, I think cloud spending negotiations are happening with erasers. And so, you have to be a little bit conservative when it comes to building in cloud growth estimates, even in the face of competitors potentially growing a little bit faster. Look, Google is not an as established player in the cloud business. Yes, they're smaller, but that doesn't necessarily mean that they could grow faster in this type of environment. And so I always say on this channel, and I preach it all the time with every model that I build, conservatism wins the day. Allow the company to outperform your expectations, and the positions that you had built do better than what you would have expected them to do. But don't allow yourselves to build so much optimism in your valuations that you end up buying these shares thinking that they're so cheap. And then, of course, the company disappoints your own expectations. And I think that's just what's happening in this market right now. And this is what I'm talking about. look at search quarter over quarter. It is up 11.3%. YouTube, you guys remember a time when YouTube was going backwards. So the fact that YouTube is up 12.5% year over year, this is absolutely fantastic. And here's the thing with cloud. How high are your expectations that this is disappointing? Cloud is up 22.4% year over year on the quarter. So either I'm missing something, and you guys can let me know in the comments below, because I do miss things. I'm only human, but this looks like a very solid quarter. Revenues are up 11% as a whole. Cloud is growing at the rate actually higher than what I would have given them credit for. I'm probably forecasting somewhere around 15. I'll check in a second. But of course, the fact that search and YouTube are back makes me very happy. And I say it right here. If you're upset over a 22.4 year over year growth in cloud, I think you're delusional. And the article goes into say just that. Sales growth in Google's cloud division slowed to 22% from third quarter last year, coming in below Wall Street expectation. Well, should Wall Street really have higher expectations? I understand that they're trying to get the next year correct. I get it. I've been in this space. I've worked here. But as investors, should we? The Wall Street is not really the buy side, right? The sell side analysts serve the buy side, the hedge funds, the mutual funds, blah blah blah. They don't have to get next year correct. And so if they are expecting that cloud is expected to grow, or they're forecasting cloud to grow at a rate higher than 22%, I think they're making a mistake. I think you always have to be conservative, especially when you're managing other people's money. I think it's nuts. And so the fact that it grew 22% and people are upset about that, again, I just won't understand that. And so I think the investor disappointment really comes from a comparative analysis versus Alphabet's competitors in the cloud space. And that's fine, but remember that this is a completely different company, much smaller, not as built, and does not have the same type of relationships as Microsoft and Amazon have. So you got to really be careful. You got to give these guys space to cook. And so cloud computing is a much lumpier business than advertising, and one where Google is faring stiff competition. So we have to be careful. Let's taper our expectations. And so this is what I mean about tapering expectations. Look at what my bar for fiscal year 2023 was. It was very low, but even in my expectation, look, for example, search, I only expected search to grow 5%, despite the fact that in 2022, it grew 9.1%, as you can see right here. YouTube ads, I was actually expecting the year to go backwards for YouTube. So the fact that YouTube is strong, and I'll show you that in a second, is very good. Now, with cloud, notice cloud grew 37% last year, but anybody who was looking at my model over the last year, however long, since the last time I updated it, you would have seen that I was forecasting cloud, I would say aggressively, maybe a little bit delusionally, but only at 20%, despite the fact that it was closer to 40% last year. Why do I do this? Because I recognize that this business doesn't grow at 40% a year forever in a straight line. I am very happy to not own Google, and it continues to outperform, and I miss out on the opportunity. The last thing I'm going to do is get very aggressive with any of these segments with my growth expectations. And so, you know what? I forecasted total revenue to grow at 4% for the year. They're vastly outperforming. In subsequent years, I'm at, the high single digits. So this might just be one of those situations where, even if Google shares come down, which they did come down to close to $100 per share, I didn't buy this year. That doesn't mean I missed out on anything. You can wait for the perfect pitch, which is a tenet of value investing. We don't have to get aggressive on these things. And this is one of those examples. And so I'll show you now exactly how Alphabet is doing in this year. Remember, I was forecasting 3.9% revenue growth. Let's see where they're at. So you can see year to date, total revenues are up 6.9%. And if I was Quagmire, I'd be saying giggity giggity goo right now. But you can see that Google search and other is actually up 6%. Remember, I was forecasting YouTube ads to decline by 5% this year. They're actually up on a year to date basis of 5%. So they are outperforming my expectations by 5%. And then cloud is actually up 26% year over year. I was forecasting, and I continue to forecast, just 20. So they have some room to give up even more, and it still meets my expectation. Now, does that mean that my valuation is correct? No, nobody's valuation is correct. But what it does mean is that it's more unlikely that I'll be disappointed. But also, I haven't seen the opportunity for myself. I was close when the shares were under 100 or closing in on $100 per share earlier this year, but there was no cigar. I just never pulled the trigger because there was other opportunities. For example, in the retail space, in the regional banking space, there was a lot of money to be made this year, and I think this might be the year where my portfolio has done the best. Fingers crossed that the year doesn't end in a total disaster, which it could happen. Now, when it comes to reforecasting Alphabet, I'm saying that YouTube ads is going to come around positive 5%. So follow the year-to-date trend. Google search, 5% as well. And then, of course, the Google Cloud, I actually pushed up a little bit to 22.5. Recall that year-to-date, they're doing 26. So they can still give a little bit and still meet the expectation. Where I'm a little bit nervous, and I'm waiting for Q4 to figure this out, is where does the digital ad spend growth go from here? Can we get YouTube back to the low double digits? I'm a little bit worried about this 10%. I want you guys to let me know in the comments where you think this should go. And then this Google Cloud, I'm okay with 22.5%. I thought this year's market was going to be really tough. The fact that they are 26% up year over year is very interesting. I don't know, maybe I'll bring this down to 17.5%. I'm not sure just yet, so I've left it where it's at. But of course, overall, you see that 2023's forecast, total revenues are expected to grow at approximately 6.3%, and then thereafter around 8.5, 8.6% year over year for the company's revenues as a whole. So nothing crazy. If I move around some of these numbers, it's not going to make a material difference, especially considering that the vast majority of the money still being generated by this business is from their bread and butter Google search. So, this number is the most important, and I'm just growing that out at 5%. That's what I'm comfortable with. And guys, don't forget what Alphabet actually is. Yes, they have some stock-based compensation expense, but they are an absolute buyback machine. You can see year to date, they have purchased $45 billion of stock, and only 16 or 17 of that went to replace some of the stock-based comp expense. And so they're absolutely reducing the number of shares. Just by that alone, you're going to see the EPS increase year over year. And of course, it's not like this is the only year that they've done such a massive buyback. Last year, they repurchased $44 billion of securities at this time, 9 months ended. So the issue really here is that this company is in a position to repurchase shares at I would say, a more accretive value now that the shares are trading even lower. And so very interesting for people who are looking to enter into this opportunity right now. But the question is, how accretive are those share purchases? We've all already said that if Alibaba was repurchasing shares right now, it would be the most accretive repurchases that they could ever make, but they haven't really been doing that because I think there's a little bit of uncertainty surrounding the divestiture of the business or just splitting it out a little bit. But with Alphabet, there's less of that concern. Yes, I understand there's some antitrust, but you can easily see that they are more willing to repurchase shares. And of course, the question is, how cheap are these shares? Well, just based on my valuation, and my valuation will probably be lower than yours because I tend to just be very conservative. So I'm just using a terminal discount or terminal multiple of 20 times earnings. And you recall, guys, that the shares are currently trading, I would say around that 20 times multiple, 21 and a half times the 2023 EPS, which of course 9 months of it is actuals, and then 18 and a half or 18.4 times 2024's multiple. So, blend those two, maybe you got around 20 times. So not so much downside on a multiple issue, I would say. And so, of course, my valuation is around $150 per share. You guys let me know where you guys are valuing it at. You could very easily be valuing this thing at 175, 200. Just depends on how aggressive you guys are on the Google search growth assumption and the cloud growth assumption. But overall, I think it's trading at less than 85% of its intrinsic value. Now, this is one of those securities that I think if you have the opportunity to buy it at a fair price or just slightly lower than a fair price, I think it's a good opportunity. And ultimately, why does someone like Buffett, someone like Munger give that advice? Why is it reasonable to buy fantastic, exceptional businesses at fair prices. And the reason for which is because those businesses can absolutely outperform expectations. And so if we are giving them expectations where they only really have to grow revenues into the single digits in order to achieve our valuation, and they're able to achieve results where they're growing those revenues in the low double, even like mid double digits, you're going to vastly outperform our expectations, and thus you get an alpha type return, in my opinion. And so in order to get access to that model that I just showed you guys, you can get access to that and all of my other research at this lower tier of the Patreon. And if you want to join us for an epic live presentation every month, you can join us at this higher tier. And so this is almost like a de facto poll that I want to make with you guys in the comment section. And I respond to all of you. How many of you guys are starting an alphabet position at this price? Or how many of you are expanding your alphabet position at this price? Let me know. Or the other part is, how many of you are staying on the sidelines and waiting for the shares to come down a little bit more? I'm in the camp of I'm waiting a little bit more. If I can get this under 75% of intrinsic value, I think I'm not only going to make a position, but I'm going to put it in my long-term portfolio where it's like a set it and forget it. So I think that's kind of how I'm going to work this one. So let me know what you guys are doing. Let me know what you guys are thinking, and I'll chat with you guys later.